All right, so more good news on the economic front, just in time for the White House ahead of President Trump's State of the Union tonight. Consumer confidence saw a huge pop this month. And listen, it was among independent voters. Forget about the Republican and Democrats. This is really about independents, and that is a huge plus. Now, overall, present conditions and expectations improved, and that's exactly what you want to see. I got to tell you something that shocked me. Even CNN admitting that the State of the Union's economy is surprisingly strong. Now, they do gloat that it's still a liability for Republicans. Joining me now, Piper Sandler, Chief Global Economist Nancy Lazar. All right, Nancy, now you titled Friday's note, "The Turmoil Continues, Tariffs, Government Shutdown, Fallout, and AI." But I got to tell you, outside of AI, I don't feel like there's a lot of turmoil. It feels like the market is sort of wait and see.
I agree. I mean, what we do on a daily basis react to some of the current
Right.
economic data, and then at the end of the week, I take a step back. And indeed, I would argue, yes, there's a wall of worry, a huge wall of worry because of some of these incremental data points. But our own daily consumer confidence survey, which you had up there a minute ago, has actually been in a rising trend since October, and the Conference Board data this morning basically confirmed that. And also within the Conference Board data, it was just a little bit easier to get a job, something that you're also seeing in measures like unemployment claims, which are historically very, very low. And importantly, small businesses, which are the job creators in this country, not the Mag 8, it's small businesses that are the job creators. 82% of jobs are in companies with less than 500 employees, and Wall Street doesn't follow those companies. And they're feeling better about the economy, and also their hiring intentions are incrementally also improving. So we think, yes, there's turmoil kind of on the surface, but under the hood, we think we are shifting up to a healthier economic backdrop. GDP last year core rate was kind of running about 2.5%, and this year it should be stronger than that, given the lagged effects of Fed easing and also obviously the importance of the fiscal support for, in particular, capital spending.
And to that point, I love what you said about the economists not paying attention to the small businesses. I don't know if the Federal Reserve does either. Small business or smaller income households, and I wish they would. With respect to policy. On that note, you wrote rosy things about the state of the consumer, and also this is ahead of tax refunds. And we've got your charts up there. We're going to leave up there for a second so the audience can take a look. All of them moving in the right direction. What about this notion, though, that could be a mirage in a sense that the top 20% are doing the overwhelming purchases out there? Will the rest of Main Street get a chance to go shopping at some point this year?
Absolutely. I think a theme that you've certainly seen in the stock market, but you're seeing it more importantly in the economy, which may be why you're seeing it in the stock market, is that you're moving towards ending this bifurcation. I think the letter K is going to disappear from economists as we move through 2020, 26, i.e. that bifurcated consumer. Within our own daily consumer confidence survey, you have seen an uptick in non-investor consumer confidence, and I think that is directly related to the charts that you just highlighted. One, the job market is improving, which is boosting income. Two, we do have this little extra booster shot from the federal government through tax refunds, but it's more than that. And we wrote about that today. It's more than just tax refunds. It is this healthier job market, which again is just starting to turn. It's still a huge debate as I meet with investors, but unemployment claims are telling us that the labor market is now more clearly healing.
To that point, the turn, beginning with that ISM manufacturing number last month, it feels like the turn has begun. I know you're bullish on factory orders. Is it too early to make the case that maybe the manufacturing renaissance has begun?
Oh, well, we've been focused on the manufacturing renaissance since 2010 from a secular perspective. Cyclically, actually, the ISM was a little late in catching the turn. We started to see signs of a healthier manufacturing economy more like in late 3Q, early 4Q. Heavy truck orders have clearly turned up. Other measures of manufacturing activity, the S&P manufacturing PMI has turned up. Regionally, you've seen healthier manufacturing activity. And so we think we are in a new stage of the manufacturing renaissance. For several reasons. One, the lagged effects of the Fed easing cycle. Rates are down. It takes time for lower rates to impact manufacturing. Second, this fiscal policy that we're seeing from the administration, the full CapEx depreciation, is really the most important CapEx incentives that we've seen since actually Ronald Reagan. And the fact that you can write off the construction of a factory immediately and that lasts through 2028 is another major reason why we're getting companies onshoring in the United States. We just heard Apple today highlight that they're going to be building Macs down in Texas again.
I've got about a minute to go. I want to ask you about AI and jobs. So Citrini puts out this report yesterday, essentially, saying, hey, companies will need fewer workers, white-collar jobs will be, layoffs will increase, displaced workers will spend less, it weakens the overall economy, sort of a negative feedback loop because of AI on the jobs market. Are you seeing that yet?
Totally disagree. Yes, you're seeing a decline in software-related jobs. They're down about, I think, 100,000 over the past 3 years. That's basically a drop in the bucket. And that's going to continue. There's something very, very common with new technologies, which is creative destruction. You lose old jobs and you get new jobs instead. So during the internet boom, or I should say after the internet boom, you lost roughly 2 million jobs in companies that got hit by the internet. But total payroll employment was up 25 million over that particular period of time. Why is that? Technological innovation improves corporate profitability through productivity, and that then therefore creates jobs. So absolutely, totally disagree. Technological innovation is the single most important way to generate a healthier economy, new industries, creating new jobs. And I think the consumers slowly but surely figuring that out. And take a look, Wall Street should take a look more at blue collar job growth versus just focusing on white collar jobs. They've really been they've had an easy path here over the past, 10, 20 years. And now we're seeing finally blue collar jobs come back. And that's what really excites me about the next decade.
Nancy, if for any reason President Trump can't do the State of the Union, maybe a sore throat or something, stand by. I'd like you to do it.
You got a great team. Someone else there can handle it. Thank you.
All right. Love your work. Thanks a lot.